Welcome. You're viewing the video version of the Citi Pirls Stock Market Commentary for May 22nd, 2016. Market breadth. With this past week's market decline, our bull-bear point and figure ratio at 0.95 fell from 1.08 last week and is now in bearish territory. The total count of securities in bullish or bearish patterns decreased 1% to 2,889. The count of bearish stocks increased 5%, while the count of stocks in bullish patterns decreased 7%. The Citi Pirls P&F Market Breadth Summary Chart shows us a market now 1 week in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe free of charge to the Citi Pirls Stock Market Commentary on a weekly basis via email, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 163 points for the fourth decline in 14 weeks. At a negative 8.99 points, it continues below all 6 highs above plus 100 and above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in accumulation mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 4 accumulation days and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, and distribution days occur when the index closes down on higher volume than the prior market day. Momentum. Now at a minus 21.99, the CCI 20 daily rose from minus 85.02 last week and is now within the plus or minus 50 range for a valid zero-line reject short entry signal if the CCI 20 daily falls next week. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 3 weeks ago, while the daily CCI 20 began a Woody's downtrend 2 weeks ago. Having begun a Woody's uptrend 3 weeks ago, the CCI 20 weekly rose to a positive 30.64 from positive 21.66 last week, and from a positive 15.23 at the zero-line reject pivot point within the plus or minus 50 range 2 weeks ago. We will continue following the results of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. All of the top 5 industries are positive and all of the bottom 5 are negative. Summary: tech, precious metals, and banking on top. REITs and retail on the bottom. Bullish, semis, disk drives, and KBW Bank have entered the top 5. Computer hardware and disk drives have left the bottom 5. Bearish, Comp Tech has left the top 5. Gold and silver have re-entered the top 5. REITs has left the top 5 and leads the bottom 5. Oil Services has left the bottom 5. S&P Retail has entered the bottom 5. Focus this week from www.zerohedge.com. We are becoming convinced that the system won't stabilize. Citi explains how central banks broke the market. A summary of an article by Citi's Matt King. The following are some key points. A significant theme of our research in recent years has been the tendency of investors to assume they live in a zero-sum world, only to face a rude awakening when they discover that markets think otherwise. On multiple fronts, we fear that what was a positive sum game previously is now turning negative, and that the potential for some recent trends to run and run is still underappreciated, with potentially far-reaching repercussions. S2P comment, deflation is gaining ahead of steam. End of S2P comment. To examine one area, poor performance is contributing to a steady leakage of flows away from traditional benchmarked funds toward total return funds, indices, and ETFs. Traditional thinking would not read too much into this. A decline in active single-name trading by some market participants should lead to greater dislocations and hence greater opportunities for others. As index or asset class or factor investing becomes more popular, so it should become harder to make money there, and money should return to single-name trading. The system should, in theory, stabilize. We are becoming more and more convinced this is wrong. What started as a simple desire by regulators to curtail excesses of leverage risks is having much more far-reaching repercussions. Each successive exit, funds migrating from expensive single-name trading to cheaper index or asset class trading, banks deciding to leave the fixed income trading business altogether, in principle increases opportunities for the rest. But if the resultant reduction in liquidity leads people to proclaim the market uninvestable, this thesis falls down. Constraints on financial leverage do not just lead to liquidity settling at a lower level. They risk sparking a cycle of ever-diminishing liquidity. Banks exiting markets do not just lead to increased opportunities for the rest. They lead to a diminished pie for all. And a world of diminished credit growth may not simply stabilize at a lower level of nominal GDP. It is likely to need continued prodding so as not to consume itself in a destructive race to the bottom. Thank you for tuning in for this week's Santu Pirls Stock Market Commentary, featuring the proprietary bull bear point and figure market breadth summary chart, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.